while the general public remains focused on retail price charts and daily market noise, a fundamental shift in the global financial architecture has been finalized behind closed doors in Basel, Switzerland. The Bank for International Settlements, BIS, the central bank for central banks, has officially moved into the final implementation phase of the Basel III Endgame regulations. This is no longer a matter of debate or speculative rumor. It is a regulatory mandate that takes full effect when global markets open this Monday. The significance of this transition cannot be overstated. For more than 4 decades, the international banking system has operated under a paradigm where paper contracts, promises of gold and silver, were treated as equivalent to the physical metals themselves. This allowed major bullion banks to maintain massive leverage, effectively suppressing prices through unallocated accounts. As of Monday, that era of paper alchemy is being systematically dismantled. The implementation of the Net Stable Funding Ratio (NSFR) marks a Nixon moment for the 21st century. In 1971, the world moved away from metallic backing toward a pure fiat system. In 2026, through these new banking regulations, the system is being forced back toward tangible assets. This isn't happening because the banks want it. It is happening because the regulators have recognized that the current level of derivative leverage is an existential threat to global financial stability. Today, we will analyze the technical mechanics of this shift, the sudden liquidity vacuum in the precious metals markets, and why this regulatory reset is forcing the largest financial institutions in the world to abandon their short positions and secure physical inventory at any cost. The core of this transition lies in the reclassification of assets on bank balance sheets. To understand why Monday represents such a critical deadline, we must look at 2 specific components of the Basel III framework: Tier 1 asset classification and the Net Stable Funding Ratio (NSFR). The reclassification of gold and silver. Previously, gold was often treated as a Tier 3 asset, similar to a volatile stock. This meant that banks had to apply a significant haircut to its value when calculating their required capital reserves. Under the new mandate, gold is being elevated to a Tier 1 asset. This puts physical gold on the same level as cash and sovereign treasuries. It is now classified as a risk-free asset. This change provides a massive incentive for banks to hold physical metal to strengthen their balance sheets. The Net Stable Funding Ratio (NSFR) and the paper loophole. The most disruptive element of this rule change is the NSFR. This ratio requires banks to maintain a reliable profile of stable funding against their assets. For decades, the London Bullion Market Association (LBMA) and major U.S. banks used a loophole that allowed unallocated gold and silver, essentially paper claims, to be counted as high-quality assets. Starting Monday, the NSFR treats unallocated paper metal as a liability rather than an asset. Holding these paper contracts now carries an 85% stable funding requirement. In simple terms, it has become prohibitively expensive for a bank to hold a position in silver or gold that is not physically present in their vaults. The rules now penalize banks for holding naked short positions, bets that the price will fall without having the physical metal to back them up. The Monday deadline. This regulatory reset has forced a scramble in the overnight and interbank markets. Banks that have relied on fractional reserve bullion banking are now required to either purchase physical metal to back their positions or exit the paper market entirely by closing their short contracts. This is not driven by market sentiment or a sudden change in investor appetite. It is a matter of regulatory compliance. The banks are being forced to choose between physical acquisition or bankruptcy under the new capital standards. The liquidity vacuum and the end of price suppression. In the week leading up to this deadline, we observed a phenomenon described by many as a liquidity vacuum. Market makers, the institutions that usually provide the ask and bid prices, withdrew their sell orders. This wasn't a technical glitch. These institutions were recalibrating their algorithms to account for the fact that selling paper silver is no longer a viable business model under Basel III. For 40 years, institutions like JP Morgan and Citi could hold massive short positions to suppress prices because the cost of doing so was negligible. Now, the cost of carry has skyrocketed. When banks shift from being the primary sellers of paper to the primary buyers of physical, the price floor of the asset rises permanently. We are witnessing the end of fractional reserve gold and silver trading. The industrial conflict. The race for physical supply. This rule change creates a direct conflict between the banking sector and the industrial sector. Companies such as Tesla, Samsung, and Apple require silver for the production of electric vehicles, semiconductors, and solar panels. Historically, these companies benefited from the low prices maintained by the bank's paper manipulation. However, as banks are now forced to hoard physical silver to meet their Tier 1 capital requirements, the available inventory for industrial use is shrinking. We are seeing early signs of panic buying in the industrial sector. Manufacturers are attempting to lock in supplies before the banking sector absorbs the remaining global inventory. There is simply not enough physical silver produced annually to satisfy both the industrial demand of the Green Revolution and the new capital requirements of the global banking system. C. The geopolitical pivot. The Eastern model wins. It is significant that China and the Shanghai Gold Exchange have been compliant with these physical-only standards for months. The East has long emphasized the accumulation of physical metal over Western paper derivatives. By passing Basel III, Western regulators are effectively admitting that the Western model of paper alchemy has failed. This is a strategic concession. The West is aligning its banking regulations with the East, acknowledging that in a period of high debt and currency instability, physical metal is the only true safety. This transition levels the playing field for countries like Russia and China, which hold massive physical reserves, while placing the debt-heavy Western nations at a significant disadvantage. D. The devaluation of the dollar and the rise of stagflation. The revaluation of gold and silver as Tier 1 assets has a direct negative impact on the US dollar. To purchase the physical metal required for compliance, banks must sell other assets, primarily US dollars and treasuries. This creates downward pressure on the dollar at the same time that gold and silver are being revalued higher. Furthermore, as banks are forced to hold more capital, they will naturally lend less. This will trigger a credit crunch in the general economy, making it harder for businesses and individuals to obtain loans. This deflationary pressure on economic growth, combined with the inflationary pressure of currency devaluation, leads directly to a stagflationary environment. In such a scenario, silver has historically been the top-performing asset class, as it serves both as an industrial necessity and a monetary hedge. E. The exposure of fraud. The coming audits. With the implementation of Basel III, we expect a new wave of stringent audits. Regulators will no longer accept a bank's word that the metal exists. They will require proof of allocation. For years, there have been suspicions that banks were double-counting leased metal, counting the same gold bar on multiple balance sheets. As these audits commence this quarter, any bank that cannot prove physical possession will face severe penalties or closure. This creates a doom loop where banks must buy metal on the open market to cover their shortfalls, driving the price up against their own short positions. The implementation of Basel III Endgame this Monday is the signal that the global financial cycle has turned. The era of infinite leverage and paper manipulation is being replaced by a system of transparency and physical backing. This is a slow, bureaucratic return to a gold standard disguised as banking regulation. The institutions that have managed the global economy for the last half-century are admitting that fiat currencies are failing. They are preparing their lifeboats, and those lifeboats are made of gold and silver. This is a massive transfer of wealth. Those who hold paper assets, including unallocated metal accounts at major banks, are at risk. If you do not hold the physical metal, you are essentially holding a bank's liability at a time when that bank is being forced to deleverage. The mainstream media will likely ignore the technical details of the NSFR and Basel III, focusing instead on market volatility without explaining the root cause. But the root cause is clear. The rules of the game have changed. The system is being forced to be honest for the first time in 40 years. As the banks step back from manipulation due to these new regulatory costs, true price discovery will finally occur. The price of silver must rise to a level where physical supply meets physical demand without the interference of paper dilution. That price is significantly higher than what we see on the screen today. The banks are buying, the nations are buying. The question is, are you aligned with the new rules or are you still betting on the old ones? Follow the money, monitor the regulatory shifts, and prepare for the Basel III era.
The morning of December 24, 2025. While the world was submerged in the glow of Christmas lights and the comfort of holiday carols, A silent explosion was tearing through the gold vaults of London and New York. While you were distracted, the very foundations of the financial system shifted. Silver, the asset once mockingly dismissed by the elite as the poor man's gold, has officially shattered every boundary of logic. It hit a fresh, staggering, all-time high of $71.92 per ounce. This is an apex never before seen in human history. But stop for a moment. Ask yourself the question they don't want you to ask. Why is the mainstream media so hauntingly silent while this asset has surged over 140% in a single year? In the shadows, a smart money predator is at work. While the retail crowd is hypnotized by the volatility of Bitcoin or the overextended tech bubble, a calculated force is draining the liquidity out of the precious metals market. This is not a random price spike. This is a structural uptrend, a meticulously engineered revaluation of reality. Welcome to the dark side of the flow. Today, we peel back the skin of the market to reveal the truth they are trying to hide.
Let's examine the forensic evidence. In a year where gold has performed exceptionally, rising 76%, a figure that would usually dominate the headlines, silver has literally devoured its older brother with a 140% explosion. Why? To find the truth, we must follow the trail of the whales. Evidence number 1, the historic short squeeze. In October 2025, a classic predatory script was written. The massive hedge funds and bullion banks attempted to short silver, betting on its collapse. But they didn't count on one thing: a wall of steel. A massive short squeeze was triggered, a financial vortex that forced the bears to buy back their positions at any cost to avoid total annihilation. This was the moment the coiled spring, suppressed for over a decade, finally snapped. Evidence number 2, the silence of the giants. Look at the data from the MCX. Silver futures for March have vaulted to a record 223,000 rupees per kg. The central banks and major ETFs are no longer buying in small, polite increments. They are vacuuming up every ounce of physical metal available on the global exchanges. They know what is coming. They see the US dollar bleeding out after 3 consecutive Fed rate cuts. When fiat currency loses its soul, silver becomes the final safe haven for the elite before the financial tsunami hits the shore. This isn't a trade for them. It's an escape.
Why has silver become rarer than gold? To understand the why, we must connect the geopolitical dots that the media ignores. The geopolitical trigger. The crisis in Venezuela is far more than a story about oil. When the US blocked those tankers, it sent a shockwave through the global supply chain. In a world of absolute uncertainty, safe haven assets are the only place where capital survives. But silver has a dual identity that gold can never match. The industrial necessity. This is the kill shot for the bears. As experts like N.S. Ramaswamy have confirmed, silver is the next generation metal. It is the industrial blood of the 4.0 civilization. Do you want electric vehicles? You need silver. Do you want solar energy to power the net zero transition? You need silver. Do you want the AI revolution and the hardware for global digitization? You cannot exist without silver. We are entering the era of physical scarcity. Silver is no longer just a currency. It is a critical component for survival in the digital age. When surging industrial demand collides with a supply system that has been fractured by years of underinvestment and deficits, the price is no longer determined by a digital ticker. It is determined by the survival of the world's most powerful tech corporations. They will pay any price to keep their assembly lines moving. Where is the terminal point of this madness? The target being whispered in the corridors of power and within Access Direct reports is $200 per ounce by 2026. That is a 300% increase from the current peak.
But listen closely, because this is where the smart money sets its most dangerous trap. Do not let the euphoria blind you. The history of silver is littered with the corpses of retail investors who got too greedy too fast. Silver is famous for its boom and bust cycles. The house, the market makers, will not let you ride this wave to $200 without a fight. Expect bone-deep corrections. Expect fake-outs, artificial price drops designed to shake out the weak hands and trigger your stop losses. This is a psychological war. They want your physical metal, and they will use every trick in the book, from media-driven panic to high-frequency trading dumps, to scare you into giving it to them. If you sell too early, you lose. If you buy the top out of FOMO, fear of missing out, you also lose. The final verdict? Our investigation confirms that silver has finally escaped its decadal prison. We are standing at the foot of a financial tsunami. Stop looking at silver as a mere commodity. See it for what it truly is, an insurance policy for your wealth in a fracturing world. To truly grasp the gravity of the $200 target, we must look at the fracture of the paper-to-physical ratio. For years, the price of silver was controlled by paper silver, derivative contracts that far outnumbered the actual metal in existence. This allowed them to keep the price artificially low through a process of digital dilution. But the October short squeeze proved that the paper king has no clothes. When the industrial giants, the Teslas, the Samsungs, and the Apples of the world realized that there isn't enough physical metal to fulfill the paper contracts, the iceberg orders will surface. We are seeing a liquidity void. The moment the market realizes the vaults are empty, the price will not move in percentages. It will move in gaps. It will open Monday morning $20 higher than it closed Friday night. Furthermore, the gold-silver ratio is screaming for a correction. Historically, when the world enters a period of high inflation, silver outperforms gold to close the gap. If gold is at $4,500, a historical ratio of 20-to-1 would put silver well above the $200 mark. This isn't speculation, it is mathematical gravity. The smart money is already positioned. The sharks have already eaten. The question: we are at the beginning of a multi-year structural bull market. The $72 peak of December 2025 is just the opening act of a much longer, more violent play. The path to $200 will be paved with volatility, manipulation, and fear. But for those who can see through the fog of the mainstream media and understand the forensic reality of supply and demand, the opportunity is clear. Stay sharp, stay cynical, and most importantly, stay positioned. The whales are already in the water. Are you ready to swim? Watch the flows, follow the metal, and never trust the paper. Look at the screens. Look at the faces on CNBC and Bloomberg today. The so-called experts are losing their composure. They're whispering in panicked tones about gold, silver, and copper, simultaneously hitting new atmospheric highs. They call it absurd. They call it unsustainable. They stare at overbought RSI indicators and tremble at the ghosts of the Hunt brothers from 1980. Their advice to you: don't buy here, the risk is too high, the bubble is about to burst. But let me tell you a bitter, cold truth. While the masses are scratching their heads, unable to comprehend why prices keep climbing, the smart money is executing the final stages of a perfect accumulation plan. Why is silver, an asset long dismissed as the poor man's gold, currently annihilating the performance of its big brother? Why are central banks ignoring silver to buy gold, yet silver's price continues to rise like an unstoppable monster? Today, we are not going to look at charts like amateurs. We are going to perform a forensic autopsy on the silver market. I will show you the fractures in the global supply chain, the hidden secrets of declining production quality, and the real reason why a massive liquidity squeeze is about to turn this market into a literal war zone. Fasten your seatbelts, because after today, you will never look at a silver coin the same way again. Let's begin our investigation with one question. Who truly owns this game? The experts love to talk about speculative froth, the bubbles forming in the futures and options markets. They claim prices are only rising because people are chasing vertical charts, but that is merely the surface-level distraction they want you to focus on. The real truth lies deep within the minds. Look at the data. We are facing an unprecedented crisis of production and quality. For over a decade, the world has starved the mining sector of investment. Capital flowed into big tech and speculative crypto coins, while the actual lifelines of the global economy were left to rot. The result? Modern silver mines aren't just failing in quantity, they are suffering from severe production quality issues. Silver isn't something you can just dig up on command. It is usually a byproduct of mining other metals like copper and zinc. And when those primary mines hit trouble, the silver supply is strangled at the root. Look at the volume profile. The massive buy orders aren't coming from retail traders suffering from FOMO. They're coming from iceberg orders. Gigantic buy blocks broken into tiny pieces to avoid shocking the market too soon. They, the whales, are vacuuming up physical silver. Why? Because they know that physical demand is vastly outstripping the capacity of the exchanges. You see, the analysts were right about one thing. Central banks aren't buying silver, but industrial whales are. They aren't buying it to store in a vault. They are buying it to ensure the survival of their technological empires. When you cannot find enough physical silver to settle the paper contracts on the futures market, a short squeeze is inevitable. Those currently shorting the market, those who believe the price is too high, are about to be vaporized when they are forced to buy back at any price to close their positions. This isn't just trading, it's a financial execution.
Forget outdated economic theories. We are living in the era of electrification. If copper is the nervous system of the global power grid, silver is the heart of clean energy. Do you have any idea how much silver is consumed by a single solar panel? The solar explosion isn't just an environmental trend, it's a survival race for energy independence. And don't forget the retail sector. As gold becomes prohibitively expensive, moving beyond the reach of the middle class in India and China, what do? They pivot to silver and platinum. This creates a massive retail bid wave that is silently pushing the price floor higher every single day. But here is the most thriller aspect of this investigation, the global arbitrage game. Look at the yawning chasm between the COMEX in New York and the LME in London or the Shanghai Exchange. Why is the price in the US higher while reserves are lower? The answer lies in two words: tariffs. The financial elite are betting on a future where trade barriers are erected. They are moving silver into the US, stockpiling it in warehouses at record levels. They know that once new tax policies are realized, importing silver will become exponentially more expensive. This is a preemptive strike. Smart money doesn't wait for the news to break. They create the news. They are building a silver wall in the United States, while China is aggressively hoarding supply to fuel their ambition for green tech hegemony. The silver shortage is no longer a forecast, it is a mathematical reality. When demand from AI data centers, smart grids, and billions of Asian consumers hits all at once, while supply is trapped in crumbling, underinvested mines, what do you think happens? That is the moment the financial spring is compressed to its absolute limit.
The crowd out there is still obsessed with analyzing inflation numbers and parsing every word from Jerome Powell. They are waiting for a dip to take profits or to find an entry point, but they fail to understand that the very structure of the market has shifted. The current price of silver is no longer just a number on a screen. It is a scream from a system that is desperately running out of resources. When the spreads between global markets close and when the final tariff barriers are set, we will witness a springback that the history of finance has never seen before. Look at the silver chart one more time. That isn't a bubble, it is a liquidity vacuum.
Once the price breaks through the final psychological resistance levels, there will be no one left to sell. There will only be desperate buy orders from hedge funds whose accounts are being incinerated. Here is my insider advice to you. Do not sell early. Do not be deceived by temporary speculative froth or minor pullbacks. They, the true manipulators, want you to cough up your last ounces of silver so they can finalize their hoard before the true storm makes landfall. We do not trade based on hope. We trade based on the alibi of the money flow. And the evidence today shows silver is being weaponized. The price of hesitation will be devastating. Do not stand on the sidelines watching this war zone from a distance. Understand the rules of the game, follow the tracks of the whales, and protect your wealth before the door of opportunity slams shut forever. The truth is often brutal, but it is the only thing that will help you survive this market. Are you ready for the greatest silver squeeze in history? Subscribe, turn on notifications, and share this video. We will see each other in the next emergency update.